Welcome to the Monetary Mixtape with Will Hoffman, founder of Hoffman Wealth Management. In this podcast, we help fellow Gen Xers simplify complex wealth issues that are important to Gen X. We do this by cutting out the mundane material and using a refreshing approach to finances in a way this skipped generation appreciates. Join us for this ride where we explore financial planning and wealth management as Will Hoffman draws from almost 20 years of experience and brings to you qualified guests to help be your latchkey to tricky monetary affairs.
Welcome to Monetary Mixtape with your host, Will Hoffman, where we talk about the ever-forgotten Generation X. I'm Wendy McConnell. Hey there, Will. Happy New Year.
Happy New Year, Wendy. How are you?
Oh, I'm doing good. I have high hopes for 2023, and we have a guest with us today.
Yes. Very excited to move into 2023, and the New Year's always a fun time to talk about where we see the world and how we see the next 12 months from an economic standpoint. So joining us today is Jeffrey Roach from LPL Research, our chief economist that supports the research that goes into a lot of the talking points that we have with our clients and put on the show. So Jeff, welcome to the Monetary Mixtape.
Hey, fantastic to be with you, and Wendy, Will, both of you. An early Happy New Year.
Yes. So we do every year. We have the annual outlook that LPL Research provides to us that we send along to our clients, and it really gives us a lot of themes for the year, whether it's investing, whether it's wealth management, financial planning standpoint, and importantly, and where your input comes in is from a broad economic standpoint. So just before we get into the outlook, a quick introduction of you and LPL Research and how you support us and our clients.
Yes. So, Will, thanks for highlighting the outlook. We'll talk more about that. Super excited about the theme. Didn't quite use the graphics that I wanted, by the way. So just before I talk about, in my mind, as I was thinking, supply and demand curves, right? I mean, it's all the economics, the equilibrium, the balance. So I sent to our marketing team and some of my colleagues this picture of I don't know if you can have this in your mind's eye, but it's these old pictures of these guys riding these old fashioned bikes where the front wheel is like 5 feet tall, and then the back wheel is this tiny little thing. And so I had finding balance, playing up the just the weirdness of riding a bike like that, and then of course as it ties into supply and demand type of imbalances. But it turned out to be a really fun project. But yes, I'm chief economist for LPL. We have a great team. Mark Zabicki is our fearless leader, trying to herd all of us butterflies moving around. And he's got the hard job to do, but we cover bonds, equities, big picture, global macro. We cover technicals, look at commodities. So we really try to cover as much of the world as possible from all our different angles. And so the team is growing and still growing. It's going to be growing even more in 2023. So very excited about that. So my background as an economist, I started my career coming out of graduate school, working on a Ph.D., coming on the corporate trading desk at Bank of America. So we were talking about Wall Street before we went live on this podcast. And boy, I tell you, it was like learning another language. I thought I knew a lot, and then I came on a trading floor. But that's how I learned my craft. It was a great experience, but it was crazy.
Now, and were you on the exchange or on a trading floor for Bank of America?
Right. So Bank of America is headquartered in Charlotte, North Carolina. That's where I sit today as well. But started the career back on the corporate desk. So this was pre-Dodd-Frank. So this was proprietary trading. So on the corporate desk, we didn't care about clients. We weren't on the retail side. All we cared about was maximizing trading revenues for the firm. So we were trading the bank's money It was like I said, it was a lot of fun. It was a great place to start. But yeah, corporate trading desk in Charlotte, North Carolina, and was there for a few years. And finally realized, as a growing family, realized, I really do like maybe a little less pressure in my life.
Yeah. Well, and when I think of a trading desk, I always think of, the movie Wall Street from the 80s and Bud Fox, sitting at the trading desk with, at that time, there were phone cords all over the place and people running back and forth, and, some of the high pressure abusive language that they would throw back and forth to one another. And then even with Shia LaBeouf in the sequel, they, or in the reboot, I guess, that they still had the trading desk, but he was on the bank side there. So yeah, I never made it to a trading desk. I don't know that I would have had the gumption to sit there and go through those high pressure situations, but I see what you mean.
When you say trading desk, do you mean like on the floor, like what we see, like with the yelling and the papers and all of that?
Yeah, so it's a little bit different than the retail desk. So, in a lot of times when, they present things, in the movies, it's, this the phone calls or whatever, back in the day, talking to clients. In this sense, yes, all the craziness, all the yelling, all the shenanigans. However, the difference is, we had one client really, and that was, the CEO of the bank.
Got it.
So, there was that's a slightly different, purpose of what you're trying to do. But in terms of, the action, as an economist, I was sitting right there next to the traders. And so when anything came across my Bloomberg screen, okay, the traders would, yell and say, well, what does this mean? Right. In that sense, there's not much of a difference where you're getting inundated with data and you're looking at your screens and you're figuring out, I need to be the first one to figure out what the trend is, what the trajectory,
right?
Just an inflection point, things of that nature. So it's very exciting. But in some ways, I love the corporate desk because we didn't care about we didn't have the retail side to bother us, if you will. Right.
Yeah. Now we yell through email and you have 17,000 of us yelling. Yeah, right, Jeff, what does this mean?
Right. Exactly.
Jerome Powell's at the microphone. What does this mean? Right.
A great place to learn the markets. And, I realized, that there's value in textbook knowledge, but let me tell you, there's a lot of value in, boots on the ground experience. And then I moved from a corporate trading desk to a portfolio manager and chief economist for an asset management firm, institutional money management. Mm-hmm. So very much involved in those conversations of portfolio allocation. What does it mean to be overweight, underweight relative to a benchmark and things of that nature? So I did that for several years. And that was fantastic. Most recently, before LPL, came from Silicon Valley, working at Visa. Wow. That was quite fun and invigorating to be in the Silicon Valley world. But I will have to say it's nice to be back in the Southeast.
Nice, especially as we head into winter here. Yeah, I can't say that I blame you. I wanted to bring up something that we talked about before we started recording. As we talk about the movie Wall Street, and we were talking about the movie Top Gun, you had a really interesting statistic about Generation X and our impact on the economy.
So, we data wonks, love to look at the numbers, and, the government is able to track more than what we probably want them to track, right? But that's a whole nother conversation. Right. That's not where we want to go here. But in terms of looking at, how different generations spend their money, and one of the things that hit me, and I highlighted this before we started the call, but it's worth talking about, Gen Xers spend a large share of their annual total spending on entertainment. I'm a Gen Xer, so we like to be entertained. And when you think about Gen Zs and millennials, and then the boomers and the silent generation, all of those, you say, okay, it's notable where how Gen X spends on entertainment.
Can I ask what is considered entertainment? Are we talking about video games? Are we talking about movies? Are we talking about concerts?
Yeah, amusement parks, all that you mentioned, Wendy, anything, that's related to, what we do in our spare time. Those kind of, specifically movies and amusement parks, recreation, things of that nature. It's all considered entertainment.
So thinking about, the last 12 months or 18 months, and as we head into 2023, how do you see economically that impacting Generation X, knowing that, we're going to Disney, we are going to the movies, or now, watching movies in much different ways than we were 3 or 4 years ago? How do you see that impacting Gen X now?
Right. So Gen X has a large share of, home ownership, right? The home ownership rates are high. And so in many ways, inflation doesn't hit the Gen X crowd like it hits other, particularly lower cohorts.
Okay.
And, unfortunately, it is a tough time for lower income rental households.
Okay.
You think about it, if you were smart enough to refinance, I moved from Silicon Valley to Charlotte, North Carolina. I closed on the contract and negotiations the end of 2020. I have a 2.5% rate. We bought a house before housing went crazy, and we have a fixed rate. So you think about this dynamic of very low mortgage rate payments, and then you think about the percentage of the economy that has to deal with rental increases. And I think, in some ways, the upper income, those that are in the peak earning years, Gen X is in that category, peak earners right now. I think it's a call for graciousness and consideration to those that are feeling inflation a lot worse than the Gen Xers.
Sure.
We don't have to worry about a 35% monthly increase in rent. For that nature, and inflation impacts Gen X much differently and much less than other generations. I think it's a call for, like I said, a call for greater understanding for those that are in a much tighter spot. Unfortunately, it's kind of like the tale of two economies. It's the haves and have-nots, and if you're in the haves, and maybe a little footnote, the haves would be, home ownership, steady job, et cetera, et cetera.
Sure,
if you're in that category, yes, you have to deal with higher eggs prices, right? Higher dairy costs and that kind of thing. But the vast chunk of what you spend money on, which is housing, has been fairly flat.
Okay. Yeah. And that's, as we have our discussions with our clients, that's hearing the spectrum of the inflation impact over the last 12 months has been very, very different. When it comes to boomers being retired and in their distribution phase, they're feeling inflation a little bit differently, while they don't have a mortgage or aren't really shopping for a house or something at this point. They are concerned with their spending because their money has to last for the rest of their lives.
Well, and medical care, medical services have been really a little bit of that outlier.
Yeah.
In fact, just to tie it into, the most recent press conference from Chair Powell, it's all about those core services, X housing, and to put that in everyday English for Main Street, it's medical care services.
Yeah.
That's what it's all about. And that's one of the things that is concerning for those that are, the measuring and tracking the inflation dynamics right now.
Right. And our younger clients who have, just started their careers or in the very, very early stages of their careers that are trying to advance their lives, buy homes, get married, all the, inflation is impacting them. And they feel like it's delaying. And, when I talk to my peers, I'm late Gen X, sometimes get lumped into that Xennial cohort. The cost of daycare has gone up for us and our kids, but like you said, we are firmly in our homes, we are firmly in our jobs, we hope. And that inflation conversation is much different with the generation. So thank you for that insight. That's Yeah, Disney's going to be a bit more expensive, and maybe we vacation a little differently this year, but there's greater things to worry about from a broad-based economic standpoint. As we talk about the 2023 annual outlook, finding balance, which we will be having a video that we're going to do, the presentation kind of webinar style that we put on our YouTube channel. What were some of the major themes that went into 2023, or that you see in 2023 emerging, specifically on how you think that may impact Generation X?
Well, it's kind of the next stage of what we've called, say, in previous years, 2021, for example, the reopenings,
Sure.
That was kind of the conversation. I think what we were trying to get at with the 2023 outlook was, it's this next chapter in the reopening, meaning, we're starting to see a little better improvement in supply chains, the movement of goods and services across economies, regions of the world. And so, we're finding that balance, and it's playing off of that inflection point between, 2020, government shutters so many of the businesses, everything moves to online. We shift as consumers from, the services spending to all goods spending. We've pulled forward a lot of our goods spending, right? So, we bought our furniture, bought our appliances, did our housing renovations, that kind of thing for, home offices. 2023 is going to be a little bit of a challenge because we're not going to have the same level of goods purchases in 2023 because it was pulled forward this year. Okay. And we'll probably have that recession where we talk about the higher recession risks in 2023. It's not necessarily a done deal because the data is just, hey, we're slowing down. And in fact, just a little bit of a, kind of a side note, when you think about our 2023 outlook, it's really important to pair it with our 2022 mid-year outlook. It really comes together. You don't want to think about, hey, here's one outlook, here's another outlook. No, it's really chapter 1 and chapter 2, the same book. We're talking about managing turbulence. That's what it was, several months ago, managing turbulence in this soft-ish landing, meaning we know the economy is slowing, a lot of pressures that are, going to suppress economic activity. And, we had that picture of the airplane, on the front page of the mid-year outlook. Well, now it's finding that balance as we approach kind of that next stage of a post-pandemic world. Yes, things are more expensive. If you own a restaurant or own a services type of industry, you're not going to have the same kind of volume, right? We took out 20% of the tables in the restaurant, right? You're just not going to have the same kind of volume. So yes, you're going to have to spread those costs over a fewer number of customers. But we're finding that, balance between how are we going to, the demand and supply, find that beautiful equilibrium point that, hey, may not exist in real life, but in theory, you were trying to find that equilibrium point that we're always searching for, right? It's an ongoing quest to find equilibrium.
Well, and that supply demand conversation is always intriguing. It's an often misunderstood concept that consumers don't always quite wrap their heads around, or it's an ever moving concept also, where supply demand can change, day to day. And if I'm hearing correctly, if we've pulled that goods spending forward, seeing that slow should bode well for the inflation impact. Am I understanding that correctly?
That's exactly right. So one of the challenges this past year has been the supply constraints being one of the major contributors to inflation. And the Fed has no control over that.
Right.
Zero, their toolbox doesn't address that problem. Now we're starting to see with supply chains improve, it really is a demand point. People savings, people are still spending, Gen X really, right? Because they still have discretionary monies that they're spending. And so, that aggregate demand, that strong demand has been pushing up inflation. Now that demand is kind of going to slow, the economy's perhaps going to be in a recession first half of the year, it's going to be a demand slowdown. That's exactly what the Fed wants to see, meaning tighter policy will actually have an impact. And, and I think in the US, at least, I think that conversation of peak inflation, have we passed it? The answer is yes. And I think that's why markets, in some ways, even though we're struggling in the last recent days, markets have recovered from the lows of October, obviously those of June, right? You kind of retest that bottom, and now we're still, at that 3,900 type level at the S&P. And that's because inflation is on the right trajectory. It's still, yes, very, very hot, way above the Fed's target, but the direction is right. We're cooling down.
Hey, sorry for the interruption. I know you're listening to the Monetary Mixtape because you want to learn about financial planning and wealth management. If you have any questions at the end, please head over to www.hoffmanwealth.com or look in the show notes to schedule a call with us.
Okay, well, good. That's good to hear. And when we talk about 2023, what opportunities do you see, and specifically for Gen X, but whether it's equities or bonds or general economic opportunities in general, where do you see those?
Yeah, I think speaking of Gen X and those that are still earning an income, they're not quite in that distribution phase, as you mentioned early in the call. I think it's possible that Gen Xers particularly can look outside the traditional asset classes and look at the alternative classes and say, hey, 2023 might be a great year for increased exposure to alternative assets.
Okay.
So I think another opportunity potentially in 2023, maybe in the latter half, is looking outside of the U.S. So we've been focusing, even in our publication and in the Outlook, we focused about the relative stability of dollar-denominated assets. Treasuries are still a safe haven, whenever there's concern globally, and that's still going to hold for a little bit. But as things normalize globally, I think it's fair again to have that, as I say, it should be an agenda item on the conversation. Yeah. Of when to look, internationally, being careful, careful on, what the goal is and adjusting for risk, but look outside the borders of the U.S. eventually, and in the alternative class as well.
Well, and especially as, China's going through their early stages of reopening right now. They've had a little bit stricter response than we have. You see some opportunities there as well?
Eventually, it may be a little bit too early to say, because one of the things that is a concern, I think, from the China standpoint is, just like we saw here in the U.S., when the policies and quarantine and restrictions are relaxed a bit, you can imagine this tidal wave of millions of people, finally saying, okay, we're allowed to go out. We have greater mobility. We can travel. We can, do what we did, back in 2019. And so this tidal wave of demand could replicate what we saw here in the U.S. And that's kind of a major, speed bump that we'll just have to track and see how smoothly that can kind of work its way through. But I guess you could, in some ways, they're behind us in that we haven't seen that tidal wave of demand flow out yet, because of the relaxing of mobility and restrictions and testing, et cetera.
Okay. What about, warning signs, things that we need to be cautious of or watching for? And we're going to discuss all of this in our video that kind of gets launched at the same time as this episode. But what big warnings do you see that we should keep our eyes on?
Well, I think one of the biggest challenges that's a little bit of an unknown and certainly a risk is if the job market really deteriorates. Then if we do indeed fall into a recession next year, it's not going to be this short and shallow conversation, right? Because part of what's propping up the economy, even amid very high inflation rates, is you have excess stock of savings, and you have a fairly decent labor market, depending on, what category you're looking at. Hence, the unemployment rate's still very low. That's why the Federal Reserve is so concerned about the tightness of the labor market. So, a big risk that we need to just be mindful of is a deteriorating labor market will flow into a consumer being hit a little bit harder than what we're projecting for right now for 2023.
Okay. What's your favorite part of the annual outlook this year? What are you guys most proud of with what you've given to us to present to our clients and to the world?
Yeah, I think part of it is, as we kind of move from ultra low interest rates, it's that opportunity to say bonds will act like bonds again. Maybe that was, maybe that was one of the, comforting moments that we could write about, say, okay, we know inflation's cooling, kind of getting back to, much lower rates of inflation. I think that was, a good thing to write about, and the bond component. Yeah, I think, there's a little bit of, I think comfort to know that this environment is not like, 2004 and 5, where, the market was just going crazy, particularly in housing, and then once things started tightening, and of course, Lehman blows up,
right,
and you had all these, collateralized debt obligations and collateralized loan obligations, CLOs and CDOs, as we say. We don't have that kind of risk lurking in the background that we know of yet.
Okay.
Who knows? It's possible. But it was nice to be able to write about 2023 saying, we're not expecting a Lehman moment. So that's very different as we talk about recession risks than say,
different than the last 2, I guess 3 recessions, if we're counting, the COVID year is a technical recession. Everything's had this giant singular event, whether it was the tech wreck or Lehman Brothers or, COVID. This will be at the very least a eventless type of slowdown.
Yeah, well,
it doesn't get too deep.
Yeah, well, pulling it back to Gen Xers here, I was in grad school at the time, but I'm sure there were plenty of those that were remembering in real time being in the industry with long-term capital management blowing up.
Yeah.
In the late 90s. So, that kind of, these stories where there is a trigger point, something happened that kind of started the dominoes, if you will. We don't see that. And that's always something when you think about risks. You asked me, Will, earlier about that. Yeah, I think, in terms of risks, well, we're looking for those events that would be a shock. And interestingly enough, we did have a shock in Q1 of this year with Russia invading Ukraine.
Right.
But yet that wasn't a large enough shock to really derail the global economy. Gotcha.
So if our listeners would like to follow more from LPL Research, there's a lot of ways that they can do it. Always our content that we publish on our website and through LinkedIn is a great way. But there's a lot of other ways, a lot of podcasts, a lot of videos. You want to highlight that real quick?
Yeah, I think one of the things you think about our LPLresearch.com website. I think, the blogging and that kind of thing, you can go straight to LPL.com and go under Newsroom and have our weekly market commentary and our podcasts and the different videos that we do. We have a YouTube channel. One thing too, I think some advisors have found it really helpful to follow me on Twitter or LinkedIn.
Yes.
I literally just before this call, I got a request from from an advisor saying, hey, that you posted this chart on inflation. I don't know, Will, if you saw it, but I did this little inflation dashboard. So
yes,
all these different ways in which to measure inflation. I just color coded it like you can do in Excel. It's, it's not rocket science, red to yellow to green, that kind of thing. But this inflation dashboard, I think it's a really nice visual snapshot on, where we are in different components of inflation. In different ways of measuring inflation. I literally got a request saying, hey, what was happening about 5 months, 6 months before your chart started? Because, hey, we're not going to have, the real estate to show that chart too far out. But follow me on Twitter and LinkedIn. Of course, follow the whole team, LPL Research. And we're the point that we're trying to do is we're looking at things that perhaps the general mainstream media is not publishing, and we want to provide value add for what that market narrative is. And sometimes, and many times, you have to go beyond the headlines and look into the details.
Yes. Well, and you folks are always popping up on the major networks, CNBC and Bloomberg, Fox Business, Yahoo Finance, all of those. So there's a lot of opportunities to hear from LPL Research and see them all over. So I really want to thank you, Jeff, for joining us. Look forward to having you back, maybe around the mid-year outlook. We'll be looking at hopefully some warmer weather at the very least at that point, and see how the annual outlook is started to play itself out, and how you guys see the rest of the year.
Fantastic. Well, good to be with you, and we'll look forward to further conversations.
Yes. As we look forward into 2023, I've said this before on previous episodes. This has been a very fun project for us, this Monetary Mixtape podcast. I'm enjoying myself a lot. I enjoy, spending time with you all and with Wendy and the guests that we have on. We have some really exciting guests coming up for 2023. We're going to do a series on education funding, but not just education funding from a saving standpoint. We're going to have some folks to help us navigate the financial aid tapestry and how to fill out those FAFSA forms. We're also going to have an admissions coach to help Gen X start to get their kids ready earlier for colleges and how to fill out the applications, how to do our essays, and get the most out of the opportunity that lies in front of them. We're going to have some career counselors on to talk about Gen X and navigating through our careers as we start to ascend through positions to leadership in our companies. So a lot of exciting things to look forward to. And as always, we're going to infuse the Gen X pop culture into all of those conversations, because as we have uncovered, it was a generation unlike any other. We took rock and roll and turned it into grunge and heavy metal, and then hip hop, and saw some of the greatest movies in history emerge, some of the greatest artists. We haven't even scratched the surface of my favorite part of Gen X, which is sports. So there's a lot of things that we're going to get into and talk about the sports heroes. One of my sports heroes is starting to creep into the news and ascend in his career. We see Deion Sanders, now the head coach at the Colorado Buffaloes, and watching Coach Prime start to lead young men, in a Power 5 conference is going to be really, really fun to watch. So a lot of exciting things coming. As always, you can find us at hoffmanwealth.com. Find me, Will Hoffman, on LinkedIn, and our Hoffman Wealth Management YouTube channel is where the annual Outlook presentation is going to be shortly. But from us, Happy New Year. Looking forward to a healthy and prosperous 2023, and look forward to all the topics coming up. Wendy, you want to take us home?
Well, I am looking forward to all of the things that you just mentioned. So stay tuned. And as Will said, Happy New Year. Thank you for joining us today on Monetary Mixtape. Please like, follow, and share with your friends. Until next time, I'm Wendy McConnell.
Don't bounce just yet. The street lights haven't come on. Thank you for listening to the Monetary Mixtape podcast. If you thought this episode was dope, then click the follow button to be notified when we drop a new episode. Visit our website at hoffmanwealth.com or give us a call at 724-522-5411. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Hoffman Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Hoffman Wealth Management are separate entities from LPL Financial. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.